The elite don't predict, they prepare for all outcomes. Run your own 2026 war game now. Welcome back to Wealth Architect, the place where we blueprint your path to true financial independence far beyond the standard advice of scrimping and waiting decades for results. I'm Dr. Ben, your guide through the strategies that the truly wealthy use to build, expand, and safeguard their empires. Right now, in early 2026, we're smack in the middle of what many are calling the economic reset. Tariffs reshaping trade, policy shifts altering labor and investment landscapes, inflation showing its teeth in unexpected places, and global tensions adding layers of complexity. But while headlines scream chaos, billionaires like Ray Dalio and Warren Buffett aren't losing sleep. They're running simulations that map every possible path forward. Today, we're equipping you with that same toolkit. We'll outline 5 key scenarios spanning from total downturn to rapid expansion, backed by the freshest forecasts from sources like the IMF, Goldman Sachs, and JP Morgan. For each, we'll simulate real-world impacts on your portfolio, share positioning moves from the ultra-wealthy, and provide actionable steps to fortify your own setup. This episode is your manual to transform uncertainty into a strategic advantage. Let's get into it and start building that unbreakable foundation. Let's start at the extreme end, where things go south fast. A full-scale downturn that hits harder than anticipated, dragging the U.S. and global economies into a deep slowdown. Fresh data from JP Morgan puts the odds of a U.S. and global recession at 35% for 2026, driven by labor market weaknesses, persistent price pressures, and trade policy disruptions. Goldman Sachs has dialed back their recession probability to 20% from 30%, but they highlight risks from softening job additions and tech sector layoffs. The IMF sees global growth holding at 3.3%, but if downside risks like geopolitical escalations materialize, that could plummet. In this setup, U.S. unemployment could climb to 4.8% or higher, as some models suggest, with GDP dipping to 1.6% or less, per Deloitte's outlooks. Consumer spending falters, markets drop 30 to 50%, property values in leveraged areas crash, and digital assets face heavy scrutiny. Billionaires treat this as a buying opportunity, not a catastrophe. Ray Dalio's Bridgewater Associates maintains an all-weather mix heavy on gold, which often surges 20 to 30% in such times, and short-duration government bonds for quick access to funds. Warren Buffett at Berkshire Hathaway stockpiles cash reserves, positioning to acquire undervalued companies during the panic. To apply this yourself, first evaluate your current holdings. If equities make up 60% of your assets, model a 40% market decline in a simple tool like Google Sheets. Input your positions, apply the percentage drop, and calculate the hit to your net worth. Build a safety net with 9 to 18 months of living costs in secure, interest-bearing accounts currently offering around 4%. Go further with protective measures. Consider options contracts, such as protective puts on broad indices like the S&P 500, which might cost 1 to 2% of your portfolio, but limit losses to 10 to 15%. Or look at inverse exchange-traded funds, like those tracking the opposite of tech indices for targeted shields. But remember, the real play is offense in disguise. Distressed opportunities emerge, like commercial properties selling at half price or established firms at bargain earnings multiples. Elite investors like Carl Icahn use private investment vehicles to snap these up. You can start by monitoring real estate investment trusts, or REITs, for drops below their net asset values via platforms like Yahoo Finance. Addressing a common worry, losing everything in a crash. This preparation shifts that. By simulating and adjusting now, you could turn a broad 50% market loss into a net 15% gain through timely acquisitions. We'll reference this baseline as we move to milder paths, showing how adaptability pays off. Add in global diversification. Accounts in stable jurisdictions like Switzerland or Singapore can insulate against domestic policy shocks, with low-cost international ETFs providing exposure without complexity. Expand the simulation. Factor in sector specifics. Energy might hold steady if supply issues arise, while consumer discretionary tanks. Test 3 variants: base collapse, 40% equity drop, mild, 25%, and severe, 60%. For each, outline your response. Sell nothing in mild, rebalance in base, deploy cash in severe. Billionaires like Jeff Bezos maintain liquidity plans, ensuring 20 to 30% in cash equivalents. Mirror that by reviewing your cash flow monthly, adjusting for unexpected tariff hikes that could add 3 to 5% to import costs. Shifting to a slower burn challenge, growth barely moves forward while costs keep climbing, reminiscent of past eras with high prices and low momentum. Deloitte projects U.S. GDP at 1.9% for 2026, with inflation accelerating to 3.1% from tariff effects. Unemployment might settle at 4.5% per Goldman and Fed estimates, as hiring slows and wages fail to match rising expenses. Globally, PwC sees 2.7% expansion, but with uneven pressures, like energy costs up 4 to 8% in some areas. Supply disruptions persist, rates hover at 4 to 5%, squeezing smaller operations, while giants in tech push ahead on efficiency gains. The wealthy counter with assets that outpace inflation. Howard Marks of Oak Tree Capital favors commodities, oil contracts, or funds like those tracking crude, which buffer against energy surges. Tangible holdings excel. Agricultural land through specialized trusts, yielding 3 to 5% plus value growth. Focus on reliable income sources, stocks in staple goods companies like those in household products, offering consistent payouts. Simulate your setup. Gauge your holdings' sensitivity to price risers. If it's high, reallocate to inflation-protected securities like Treasury inflation-protected securities or firms with pricing power. For practical steps, lock in borrowing now if rates ease. Refinance fixed-rate loans below 5.5% to free up cash. Develop additional revenue streams in durable fields, such as online services or consulting tied to emerging tech. Buffett-style moves include bets with uneven rewards, options on overlooked sectors like utilities, where potential gains exceed risks if demand spikes. Model a 3% price increase across your budget. Utilities up $150 monthly? Counter with income from high-yield investments aiming for 5% plus. This persistent pressure rewards steady adjustments. Layer in protections like diversified bond ladders for predictable returns, setting the stage for stronger rebounds in upcoming scenarios. Add billionaire insights. Elon Musk spreads across industries. Emulate with multi-sector ETFs. Extend simulations. Include personal factors, job security, family expenses, and test quarterly updates to stay ahead. Now, the middle ground, a rocky adjustment where the economy handles initial shocks but faces swings from policy changes and external events. Unemployment stabilizes near 4.5%, with U.S. GDP at 2.1 to 2.3% amid shifts, per Goldman and IMF views. Global figures moderate to 3.3%, but with potential disruptions from weather or digital threats. Markets fluctuate. A policy easing might trigger 10% upswings, followed by 5% corrections from trade issues. Elite approaches mirror consulting firms like McKinsey, mapping decision points for every variable. Musk diversifies holdings. You can hold 15 to 25% in liquid short-term instruments for rapid shifts. Use volatility tools like contracts tied to market swings. Simulate. Identify key signals, such as commodity prices over certain thresholds, action, allocate to related stocks, or central bank moves, shift to growth areas.
Tackle swing-related stress. Create a framework in a spreadsheet. If joblessness rises slightly, move 15% to safer bonds. Wealthy tactics include alternative investments like debt funds yielding 7 to 10% with reduced variability. Personal advice: invest regularly in broad indices during lows, yielding historical 12+% returns post-fluctuations. Agility defines this phase, priming for more stable outlooks ahead. Expand with examples. If AI disruptions hit, pivot to supporting industries like data centers. Billionaires like Bill Gates use scenario branches. Build yours with 4 to 5 triggers and responses. Moving upward. Stabilization takes hold, with U.S. growth at 2.5 to 2.8%, outperforming expectations, global at 3.2%. Inflation moderates to 2.1%, joblessness at 4.5%, spending holds firm. Stocks rise 10 to 15%, fixed income steady. Amplify with targeted investments, private stakes in sustainable energy or health innovations. Simulate. At 3% expansion, how do your properties perform? Refinance at lower costs. Use probabilistic models in apps, showing 75% favorable results. Bridge gaps in expansion. Add broad market funds. Consistency thrives here, leading to peak possibilities. Top tier. Surge forward. US at 3% plus, global 3.3% plus. Innovations fuel. Policies align. Leverage aggressively. Early stage tech, regulated digital assets. Simulate. Low joblessness, expand holdings, yields 18% plus compounded. Full range equips you comprehensively. Your resource. A grid matching scenarios to holdings with likelihoods like 35% downturn. Use digital sheets for projections. Review seasonally. We've mapped the 2026 landscape, your guide to strategic mastery. Engage below with your key takeaway, subscribe for more, and join our Builders Circle. Up next, putting plans into motion. Onward.